Earnings season is in full swing with major companies in banking, tech, travel, and more all releasing their quarterly results. We have expert analysis so you can better understand the numbers and what they say about the health of the American economy.
We're going to get some help to break down the latest numbers from Alphabet. Angelo Zeno, CFRA Research Senior Equity Analyst, and thank you for joining us here today. Microsoft stock up 4.69% in after-hours trading, but your first blush look and opinion of these earnings.
I think you got to love them. Definitely a drastic change to what we saw last night, and you kind of look at the results. Both companies beat on the top and the bottom line. I think what the street really cares about more than anything is the cloud numbers, and the cloud numbers looked absolutely fantastic for both companies. When you kind of look at the beat, I'd say on both sides of things, I mean, it definitely Alphabet looked a little bit more impressive, and that's why you're seeing kind of the more pronounced move on that side of things. But Alphabet also doesn't provide guidance the way Microsoft does, as well as Meta does. So that you've always got the potential for a bigger surprise or a miss on Alphabet's side of things. But in this case, definitely the trajectory is moving in the right way for Alphabet.
How big of a deal is it, Angelo, that we finally got this cash return, right? That we got this dividend being paid out by Alphabet of 20 cents a share? Oh, is it more that like they kind of had to do this, or investors were going to be disappointed?
Yeah, no, I think there's a little bit of that, to be honest with you. I mean, after your biggest competitor out there or peer within the digital ad space kind of, goes out and blows it out, in early February and comes out and throws out a big, buyback plan, as well as, initiates a dividend, I think there's definitely pressure from the investment community out there for you to do the same, especially when you kind of look across the Mag 7 names. Outside of, I think, Tesla and Amazon, I think these guys are all now doing both the buybacks and the dividend. The dividend is very small. It's not necessarily going to have any impact in terms of, their ability to kind of, pay it out at any point in time, even if that business model over time sees some sort of hiccups. So I think it's just kind of a small little olive branch out there for investors. And the buyback of $70 billion is roughly in line to what they announced the last 2 years. So no change on that side of things.
Alphabet earnings have been a bit of a black box over the years. Just wondering how much conversation you expect to hear on AI after the bell. Their Gemini offering has received a lot of criticism, just being a little bit late to the party, but they've sunk a lot of money into this, and you got to imagine they got something ready to reveal at some point in the future. Just how much are they willing to talk about that today?
Yeah, so I personally don't think you're going to hear a lot about, you're going to hear a lot about AI. They'll definitely talk it up and kind of talk about the opportunities of AI, across their cloud ecosystem, as well as kind of instilling it across, their different platforms out there. But that said, you're not going to hear much in terms of product launches or anything like that. I mean, they just had the Google Next event about 2 weeks ago or so, and they throw out some good positive news on that side of things. But when you kind of look at how the calendar is shaping up here, right, you kind of go into mid-May here, and you've got the Google I/O conference on May 14th. That's where you're going to get the commentary in terms of new capabilities from Gemini across their Android ecosystem, as well as kind of new product launches that they're going to ramp on the hardware side of things. So Google I/O is where we expect the catalyst to be as far as AI is concerned. And then, also for Microsoft state, you're going to have the Microsoft Build Conference on May 21st. You've got, the Developers Conference for Apple on June 10th. And of course, you've got kind of, NVIDIA mixed in all across there. So there's going to be a lot of AI stuff in terms of the calendar coming in, mid to late May into June.
And Angela, just one last one on Alphabet before we dig into Microsoft a little bit more. What about how much they're spending on AI? I mean, that seemed to really be the issue for Meta, the capital expenditures planned for AI development this year. You talk about all the AI news we've gotten, the AI news we're expecting from Google and Alphabet. Do they have more leeway when it comes to how much they're spending there?
So, the good news actually is when you look at the fourth quarter results that they posted out there, they actually kind of alluded to kind of a big step up in terms of CapEx. And you actually did see a big step up in CapEx from Q3 to Q4 of last year. So the trajectory was already there that there was going to be a massive pickup into 2024 and even into 2025. So, the street's been prepared for that. I don't know exactly what the CapEx number here was for Q1. My guess it was somewhere roughly in line to our expectations out there. At least when I looked at Microsoft, that also, it was actually slightly below what our expectation was for the March quarter. But for Alphabet, as we kind of look ahead here, through the rest of this year and into next year, we do think they've got a competitive advantage out there in terms of their custom silicon business. We do think they're ahead of the game relative to the other cloud players out there. So that is one advantage we do think they have in terms of the cost side of things and what they've done on the custom silicon side.
Microsoft now remains your highest conviction call in the big tech space. Recently upped your price target to $475 from $455. And what I was noticing right after the results is we saw on the back of their cloud strength, we saw shares of Amazon rising 3-4% now. And just in general, seems to be a lot of enthusiasm here behind these results.
Yeah, so I would agree with that. I would also say, it probably also, it's probably up also because of the Google Cloud news too, because we definitely saw a beat on that side of things. So it's rightfully so for Amazon to kind of take that move up because you're probably going to see an acceleration on that side of things as well. So I think all indications point to, unlike what we heard from Meta last night, where Zuckerberg was essentially preaching patience in terms of AI. What you're seeing here on the cloud side of things is, there's a big step up in terms of CapEx. They're getting a lot more GPUs on their ecosystem, next gen GPUs, and as they kind of throw that capacity online, they're able to kind of charge up in terms of the cost on that side of things. So they're monetizing AI right now, and that's the big difference on the cloud side of things, maybe relative to what Zuckerberg is doing on the Meta side of things, and it's going to take a little bit longer there. So we like kind of the numbers here as far as both Microsoft and Google is concerned for the cloud. We think the momentum will continue actually throughout 2024, and they are lapping some kind of some weakness in terms of some of optimizing some workloads in 2023. So you've also got that they're benefiting from.
Angelo, I keep trying to understand the AI opportunity, which I think is still, it's still early, obviously. They're doing great on the cloud from it. It's less clear to me what they're doing from their AI-empowered products, like a Copilot. I look at their PC business. I mean, their Windows revenue was up 11%. That's fine, right? But, this sort of like transformational promise that everybody's been talking about. Do we see that anywhere there yet?
So, I mean, I've got to dig through the numbers a little bit more, but I'll be honest with you, you're probably not going to see it yet. I mean, in terms of Copilot, or all the Copilots that they're ramping across their ecosystem, that is going to take time. I mean, Microsoft did allude to the fact it's going to be more of a second half calendar 2024 event, more and even into 2025. It's going to be more of a slower slog. You've got to get those kind of enterprise customers out there willing to pay for these Copilots out there. And it's going to be difficult. I think that's an issue that's not only a Microsoft issue right now, but it's across kind of the entire enterprise software space. And you've actually seen it in terms of the performance of a lot of these companies right now. And I think what you're seeing, at least on the enterprise software side of things, is there's a lot of AI, new AI capabilities getting thrown at these guys right now in terms of the customers. And I think right now, a lot of these customers are just holding back, kind of digesting, looking at what the opportunities are out there before they actually are starting, before they're willing to start paying for some of these services out there. So it's going to be a slower slog. I think it's definitely, you're going to start seeing it in the numbers over the next kind of couple of quarters and years. It's going to be more incremental in nature. But that said, I mean, listen, you're going to have kind of seat growth definitely slow down on the Office side of things. The hope is that, average selling prices start to pick up, as you get more contribution on the Copilot side of things.
All right, got to leave it there, but appreciate your time and insights here, Angelo.
All right, well, driving the market action in the NASDAQ today, that disappointment from Meta. Shares are off just about 15% here in the pre-market action after the tech giant's big spending plan spooked investors. Well, Meta will likely wipe out $200 billion of its market cap at the opening bell. For a deeper dive into the company's results, we want to bring in Brad Erickson, RBC Capital Markets Internet Analyst. Brad, it's great to have you here. So when you take a look at the reaction that we're seeing in shares off just about 15% here in the pre-market, does that make sense to you given the report that we read last night?
Yeah, probably an overreaction to be upfront about it, but nice to see you guys. Thanks for having me, by the way. I think from a revenue standpoint, things were generally fine. They beat sell side consensus actually for Q1 and guided slightly ahead for Q2. I think the investor side, buy side, was probably closer to an inline report. The issue was obviously cost, right? They raised the operating expense guidance modestly, and then the CapEx was the big one. They raised that 12%, 8% ahead of the street. To us, that's maybe a bit more of an appropriate magnitude.
So coming off of the year of efficiency, of course, it was celebrated given the stock price reaction that we had seen out of the gate in the first quarter of this year. Now you get these results, Brad. What is this year for the company? The year of spending, the year of CapEx?
Totally fair question. As we were talking to the CFO last night on the callback, I think it's still, obviously maybe not the year of efficiency is the quite right way to say it, but they're still very, very focused on controlling headcount costs. They kind of called out that none of this increase is really owed to anything from that perspective. So I would say from that perspective, year of efficiency is still very much in play. This is a capital expenditure issue where they're having to spend a ton of money to build infrastructure and obviously acquire GPUs to run their AI research and product development in the future.
Brad, what do you see that ultimately the impact that it's going to have, the Gen AI investments here? What is that going to do to engagement here in the longer run? And what do you see it doing, the impact it's going to have on revenue for years to come?
Yeah, for sure. We think it's a kind of the next leg of outperformance type growth relative to the ad market in general. It does a few things, right? One is that it helps them develop, we call these probabilistic models. It basically means that they're figuring out what ads are driving which conversions, and then they're optimizing and making those campaigns perform better and better. Two, you mentioned it, it recommends content, right? Everyone knows about kind of the TikTok killer algorithm. Meta's worked on that a ton with Reels in the last year, and that's going to continue to get a lot better and cause people to spend more time on it. And then third is we call it kind of, it has the potential to increase users' utility of Meta. And specifically, it's things like using a virtual assistant as kind of a research tool and a discovery tool on the internet. And then also think about businesses connecting with their customers in new ways, not just customer service, but just maintaining a much more open line of communication with their customers. That's adding actual utility. That's revenue growth for these guys. So there's a lot of ways it contributes in the future.
How accurate will those engagements with an AI type of engine or interface need to be in order for businesses to feel comfortable relinquishing that? Because they've talked about how successful conversions have been to drive purchase decisions. And now we're talking about conversions with relation to making sure that you're not losing out on the digital body language or missing out on that and ultimately dampening or hindering a customer relationship.
Yep, totally. Yeah, I think if you talk to most companies or a lot of companies, executives who have begun, certainly the ones that have a customer service or support component of their business, I think a lot of them will tell you there's still very much a human component. They want to deliver the right experience that's on brand, exactly what their kind of mission as a company or product is. I don't think any of that changes. I think with that said, I think Meta's capabilities on this front can fill in and drive a lot of efficiency there. There are still going to be a lot of sort of like trivial black and white things that customers are going to really appreciate a more direct line to the company for, even without missing out on a lot of the value that I just mentioned. Digital body language was the term you used. I like that. I may steal that. I think that's still really important, of course.
Brad, when we talk about what exactly this could mean for some of the other larger players within the group, we're seeing a reaction in shares of Alphabet here this morning, amongst a long list of companies, obviously, that are taking a hit following the results here from Meta. Does this signal anything just in terms of a reality check maybe that we could be getting from Alphabet, from Microsoft after the bell here this afternoon?
Yeah. Just to be clear, I won't comment on Microsoft because I don't cover the stock. But for the other ones, certainly the advertising names. I mean, there's two read-throughs, right? One is just on the digital ads market. I would say the fact that Meta met expectations but didn't exceed, probably could be a little bit of a net negative there. Just that we know Meta is outperforming the digital ad market. With Google, there's data out there, so investors kind of have a sense of what the results are. But I think for everyone else, given that Meta's outperforming, it could lean a little bit negative on that front. And then on the capital expenditure side, right, that hits at the cloud business and the infrastructure build. It's a positive from that perspective. All these companies are spending more. The issue, of course, is Google is both a spender on that category as well as a beneficiary, and so it kind of works both ways. So it kind of is a mixed effect for Google from that perspective.
Brad, just lastly, while we have you, I mean, we're looking at about a $75 pullback on shares of Meta this morning. A lot of investors, as they're charting their strategy for not just today's trading activity, but looking out into the horizon, trying to figure out if this is a dip that they should buy in on. What within this report tells them that there is something that they can kind of hang their hat on if they choose to do so?
Yeah, I think, Mark on the call talked about how they've been through some pretty messy transitions historically, 3 in particular, mobile, when they shifted to stories as a new service, and then most recently when they shifted to expanded into Reels, short form video. And they've always done it really successfully, but it's always started out with a period of investment and pretty volatile downward reactions in the stock. And I think this one's no different. So the question you got to ask is, as you think about, do you want to buy the stock on this pullback or not? Do you believe that AI is going to be this transformational driver for this company? If you think that they can do a lot of the things I was talking about earlier, buy the stock. If you don't, I guess not. We'd be buying it.
Brad Erickson, RBC Capital Markets Internet Analyst. Brad, always a pleasure to grab some time with you. Thanks so much.
Thanks a lot.
Snap reporting first quarter results. The social media company beating Wall Street estimates for the first quarter. Also, the second quarter sales forecast topping estimates. Joining us now is Third Bridge Global Sector Lead for Technology, Media, and Telecom, Scott Kessler. Woo, Snap is volatile one, Scott. That's all I got to say. I mean, I feel like the whipsaw sort of quarter by quarter and not knowing what to expect. So why did they beat this quarter? I guess I would ask, because it has been pretty uneven here.
Yeah, I mean, it has been a roller coaster to say the least. Look, this is a stock that was over $80 during the height of COVID in September of 2021. So even though we're seeing the stock up over 20% in after hours trading, I mean, I think it was over $16 just earlier this year. So there's been a lot of volatility, but I think most of it over the last few years has really been to the downside. What did they do right in terms of Q1? Look, it's really all been about their kind of re-architecting their advertising technology infrastructure to enable them to basically venture out and capitalize on e-commerce opportunities. So direct response advertising has been kind of the buzzword or the buzz phrase that the company has been indicating for more than a year at this point. And finally, it seems like they are largely completed with the related work. And obviously the uplift in revenues was significant, 21% growth. But when you look at what they delivered the prior quarter, or even what the expectations were for this quarter, I mean, that was a massive beat by all accounts. The question now is, of course, as we were just discussing, how sustainable is what momentum they're trying to create at this point is.
Scott, I was looking at some of their numbers here. So just for instance, average revenue per user in North America, $7.44. That's up from, the estimate was $7.08, and it's up 17% from a year ago. So that's $7.44 in America. Europe, it's $2.04. Rest of the world is $1.13. But the rest of the world is where they got most of their beat on new users, monthly active users, daily active users. Just wondering, in the ad tech scheme, they're building up their ad tech, they're trying to monetize more. Is the game plan to increase some of those average revenue per user numbers around the world?
I mean, that's the hope, right? I mean, essentially and look, this isn't an issue specific to Snap. I think what a lot of companies are finding is user growth is more possible outside of developed markets. But on the other hand, those markets are much harder to monetize. And so that's kind of the tension that you see in these constructs, where the Pareto principle is going to apply, where you have 80% of, say, growth in users coming from overseas, but maybe 80% of the revenue growth coming from the US and developed markets. And so that's something that, frankly, companies are working on. It's not an easy nut to crack, to be honest. And so it's going to require work, but it does seem like Snap finally is moving in the right direction. Whether you look at the overall revenue growth, whether you look at the fact that they're attributing that to direct response and the investments that I alluded to, or the fact that just user gains now have returned to the double digits. All of those things are encouraging. I think a lot of folks, as was alluded to earlier, are wondering how sustainable some of this performance is going to be. They alluded to what their expectations are for Q2, probably not quite as optimistic as the Q1 numbers would suggest, but perhaps they're just being conservative. And I think it's fair to say that people should feel pretty good about the performance and the outlook.
Scott, how much is the sustainability of the performance dependent on what happens with TikTok as well? The company touting the total time spent watching Spotlight, which is its answer to TikTok, was up 125% year over year.
Yeah, well, look, I guess a couple of things on that front. I think Mark Zuckerberg was asked directly about this yesterday in the context of the Meta conference call, and he said what I'm going to say. It's kind of too early to tell. We have no idea what's going to happen with TikTok. I think it's pretty clear that their parent company is going to, fight efforts to ban it in the U.S. That makes a lot of sense, but there are so many unknowns here. Nonetheless, I think at the least, what's going on potentially with TikTok is, I think, rightly seen as a potential positive for Snap. I do kind of wonder, though, whether or not as I said, the performance here is sustainable if they have this kind of positive momentum, or if expectations are going to get too optimistic and there are other issues that the company has to deal with. We've heard repeatedly from experts that Snap is in a tough spot. This is a company that is oriented around, kind of protecting privacy and personal data and brand advertising. And that's not where the world is right now. It's why performance advertising is so important. It's why they've been working on this for the past year. I'm just not entirely sure that Snap has all that they need to have at this point to really be successful over the longer term in this context. I guess we'll find out, over the next couple of quarters, but this is a pretty good start to the year for sure.
It's been a comeback story before. We'll have to see if it is again. Scott Kessler, thank you.
Let's get back to Intel. It beat first quarter earnings estimates, but guidance for the second quarter disappointed Wall Street, and shares are down in after hours, trading by some 9%. Here to discuss, Corey Johnson, the Futurum Group Chief Market Strategist. Corey, it's great to see you, as always.
Always.
Investors clearly have lost some patience with Intel here.
Yeah.
And they are just not gaining the necessary traction. Give us your sort of big picture read on the quarter.
It was an interesting quarter and disappointing guidance, surely, for the next quarter. And we'll get into the interesting part, but I think when we talk about the market part, the stock part here, I think what you see is investors kind of taking a swing. Is this going to be the quarter when Intel turns around? Is this going to be the quarter when they get the orders for the foundry business? Now, of course, we got a warning a few weeks ago. The foundry was not going well. We kind of knew that coming into this. But I think the guidance, and we'll hear a lot more on the conference call shortly, but the guidance suggests that the issues really are about getting new customers for the foundry business, customers beyond Intel for the foundry business. But and that, we've seen some hints in the semi-cap equipment makers, what we've heard a little bit from ASML and others, that maybe it's happening, but slowly. So we'll see with some more detail on the conference call. But on the other side, there were really good green shoots in the stuff that they make. The actual chips that they're making, their client products business is up 35%. I mean, really strong. The notebook business up a lot. So really strong performance from the stuff that they make. But the making of chips is proving to be a problem for them, and getting into the business that TSMC has dominated for many years.
And how do you think their new Gaudi product fits into that scheme, where they really do have to compete with a huge foundry business in the form of Taiwan Semi, and also lots of players around the globe are getting some of that stimulus money, the CHIPS Act money that's being targeted for chip makers and is starting to be deployed.
All right, so 3 issues you brought up. I'll talk to all of them. Let's talk about Gaudi. Let's talk about where they are in the manufacturing. Let's talk about CHIPS Act, starting with CHIPS Act. They have received more money from the CHIPS Act than anyone else out there. So they're in a really strong position building out their facilities all over the country, in particular in Columbus, Ohio. There have been mixed reports about how fast that is going, but I was struck by the day that the Wall Street Journal announced that they were slowing down the construction in Columbus, Ohio. I had just left the great city of Columbus, Ohio, and seen the facility, and they're building fast. Indeed, they were closing roads at the moment the Wall Street Journal's report came out. So they're clearly pushing ahead really fast there and getting a lot of money for the CHIPS Act, and that is good for the foundry business, right? The second thing we're going to talk about here. So the foundry business ultimately is going to be very difficult to do, but they are pushing ahead at really having cutting edge foundry services, and as you mentioned, in the angstrom levels, at the real cutting edge, which we haven't had in this country for many, many years. And in terms of how successful Gaudi is going to be competing with AMD, and yes, hopefully competing with NVIDIA, it's frankly just too early to tell. The designs are fantastic, but we'll see what they get in terms of client wins. I mean, NVIDIA is really sucking the air, all the oxygen out of the data center business with what they're making out there, and it hasn't left a lot of room for AMD, and Intel's not there yet with Gaudi, but the designs are certainly promising, so we'll see if customers actually go for it.
Corey, even though the foundry hasn't been seeming to go as fast as investors want it to, generally it has seemed to be the sentiment that Pat Gelsinger, the CEO, was doing the right thing by, sort of reorienting. At what point does that sentiment go away? Right? How? Like, this is the story.
I think you're right. How long is his leash?
Exactly. This is the question.
Right?
I keep
Is he taking
asking.
a long walk off a long pier?
Exactly. How patient are investors going to be with this?
Here in the Ferry
you're on
building.
the pier.
Why not? Yeah, why not? Look, who knows how patient investors are going to be? I mean, the thing about investors' patience is it goes away really fast, and they're patient until they aren't, and then they abandon a stock quickly. And I don't think that's what you're seeing right now. Now, 9% is a good move after hours. But as you mentioned, the stock hasn't done much compared to a lot of other semiconductor companies in the terms of the stocks, the Philly stocks, if you want to. It's one of, if not I think it's the second worst performer in the last year, in a year that has been great for semis. Now, is going into the foundry business the smart thing for Intel to do? Well, certainly it will. It will diversify them away from the issues that they've had around slowdowns in the PC business. Really, when the PC business catches a cold, Intel catches a fever, and it has always been thus. So could the foundry business give them lots of other business? Well, only if they execute it really well. Intel's been very good about building foundries for Intel chips for decades. But can they have the kind of open business model that Taiwan Semi has done? That remains to be proven, and I think it's going to be a long ways before we know if they're really good at this. I talked to Pat Gelsinger only a few weeks ago about this very topic. What are you going to do that's different than Taiwan Semi? And his answer to me was not as satisfying as I would have liked. He said, look, we're going to be Taiwan Semi, but we're going to be here. And we need to have diversification of manufacturing of chips. And indeed, when we look at what happened during the pandemic, I think the most difficult lingering issue was the concentration of semiconductor construction, if you will, in Asia. And it has really, it continues to spill out in the global economy. And I think even in the inflation issues we're seeing even now. Insurance, for example, right? The big economic numbers we've seen about inflation coming from car insurance. Car insurance is high because replacing car parts has been difficult and been more expensive than it had been in years past. Why? Because of semiconductor design, semiconductor manufacturing. So these lingering issues in the global economy that came because of the concentration of construction of semiconductors into Asia are going to be solved very slowly. Intel stepped into this very quickly, at least announced their plans for that. But I think it's going to take quite a while till that plays out.
Patience indeed. All right. Thanks so much, Corey. Good to see you.
It's good to see you guys. Thank you.